Hey, what's up guys? It's Ezekiel Chiu here. So this video is about the stochastic indicator. 99% of the traders are using this the wrong way. I mean, once you finish watching this video, you're going to learn how the pros are actually using this indicator, and I promise you that by the end of this video, you will have the stochastic indicator in all of your charts. Okay, so what is the stochastic indicator? I mean, this tool, it is useful for measuring, number one, price momentum. So it compares the current closing price to the historical price range of this overall specific period. I mean, you don't have to get to know that. I'm going to show you that in a while. But think of it like driving a car. So as the car is moving, right? As it's moving, like when you're driving an F1 car, when it's moving, when you got to make a turn, right? What you got to do? You got to slow down first, right? You cannot just maintain the same speed and make an abrupt turn, right? You got to slow down first before turning. So the same thing, it's like the charts, right? Let's say the chart is going, right? When the price momentum starts to slow, this signals that the trend may be losing steam and then a reversal could be on its way itself. So the stochastic indicator can be a key sign for you, right, and traders, right, to watch for this kind of potential trend shift. Okay, so this is where, for example, take a look at this. In the stochastic indicator, there are what? Two lines, right? There are two main lines, the 20 and the 80. So when price is below the 20 line, this means what? It means that the price could be what? Generally cheap. Right? The price of whatever assets that you're trading could be generally cheap. And the market is in a what? Is in an oversold territory. So this signals potential buying opportunities at that area. And then on the other hand, when the market is above the 80 line, so this means that what? The price of this asset at this point could be expensive. And the market is in an overbought territory, right? And then it signals what? Potential selling opportunities. Okay, so when you understand this momentum shifts, you can better time your entries and your exits in the market itself. Now, how does the stochastic indicator actually derive their value to determine all these overbought and oversold territories? Okay, geek alert, geek alert. Okay, so let me explain. All right, trust me, you're gonna get a full picture. Here's how to calculate the stochastic oscillator value. So, number one, you got to determine the range from the low of the price to the close. Let me give you the example, right? In this example, the low price it's $50. The closing price is $90. So the range now is between $90 minus the $50, and the range is $40. Okay, that's step number one. So step number two, that's where you got to determine the range from the highs to the lows. So in this case, the high price is $100. The low price is $50. So the range is $100 minus $50. So the range is $50. So therefore, third part, to calculate the stochastic value, right, the formula is pretty straightforward. So that's where it is the range from the low to the close divided by the range from the high to the low. So in this case, it will be $40 divided by $50, right? 40 over 50, which is 0.8. And then when you convert to percentage, it is 80. Right? So that's it. The stochastic value is 80. Right? So this indicates the what? The price is relatively high within the range of the market it is right now, right? At this given period. So the value of 80 would suggest that the price is nearing the overbought territory, right? The overbought zone, signaling what? Potential reversal or all right, not only reversal, or could be a pause in the current upwards movement. Okay, all right. So that formula is the geeky, the overall geeky part, right? But I mean, honestly, it's just good understanding to know that there is a formula behind it for most of us normal people out there. Yes. So when you see the stochastic indicator, you can now know how it derives the value. Cool. Now, next. So the number one mistake that many traders make is that they are blindly trading it solely based on the overbought or oversold signal without looking at or considering the broader market context. So for example, right, the traders may like, okay, now the stochastic is overbought, is at the overbought territory, it is above the 80, right? So now it's time to go short. I'm going to sell it. And this assumption is based on the belief that because the stochastic has entered the overbought territory, price is about to reverse downwards. But however, okay, if you have been trading for a while, you're going to notice that the market can often rally and go up even higher when the stochastic is overbought. So in strong uptrends, price can remain in the overbought area for an extended period. So just selling just based on this overbought signal alone is not a wise move, which is why most traders, they end up losing just solely relying on indicators. Okay, so here's how to avoid this mistake. Okay, when using stochastic signals, here's the thing. You got to always consider the overall trend and also the other indicators, right? So in trending markets, overbought or oversold levels, they show momentum strength, not a direct reversal signal. Okay, they show momentum strength. So rather than trading solely based on this signal, what you got to do is to blend them together with the broader analysis. I'm going to show you, okay? I'm going to show you what I mean by that. As you can see in this chart, that if you go short in this scenario, it's not going to work. This actually leads to what? A continued market rally, right? An upwards movement. That's where people are going to say that, the stochastic indicator doesn't work, this and that. No, because they are using it the wrong way. And after a while, they like, I tried selling here because of stochastic indicator, then the market went up higher. They try again, the market went higher, like, it's not going to work. No, it's because they don't understand how to use it properly. Understanding that the stochastic indicator means recognizing that it measures momentum. So shorting it when it's at the overbought area, it's like you are fighting against the trend. An overbought reading doesn't always mean that a reversal is coming. No, it just shows that the price is still strong. Next, avoid trading against the trend and the momentum, right? The trend is your friend. Don't trade against the trend. Don't trade against strong momentum. Trading against the trend is going to be a costly mistake. Chasing a short position just because you think that this asset, whatever vehicle, is overbought, right? It's going to lead to you repeatedly getting stop out. If you're going to see this example, you keep getting stop out because you keep selling, but the market keeps going up higher, right? The market can continue moving upwards with strong momentum. So therefore, trading against the momentum is going to result in a lot of losses. And that is why using the stochastic readings in overall broader context is important. And that's where you align your trade setups with the prevailing, with the overall current market trend itself. Okay, so now this is how to properly use the stochastic indicator. Okay, ready? Yeah. One effective way to use the stochastic is to what? To time the end of a pullback within the trend. Okay, so in trending markets, right, pullbacks happens, right? And pullbacks they represent this kind of temporary retracement where price move against the prevailing trend. They move against it before resuming in its original direction. So the stochastic indicator can help to identify when these pullbacks are likely to end, signaling the best moment to re-enter the market and enter along with the trend. So here's how to use the stochastic to time the end of the pullback. In an uptrend, you look for the stochastic to what? To dip into the oversold levels, right? Which is below the 20 line. This signals that the pullback, all these pullbacks may be losing momentum. Okay, all these pullbacks may be losing momentum. When the stochastic rises above the 20, it indicates that the market is preparing to resume the uptrend. So this gives you the ideal spot, the opportunity to go long. Okay, so now on the other hand, in a downtrend, you watch for the stochastic to enter into the overbought territory, right? Which is above the 80 line during pullback. So the market is in the downtrend. During the pullback, you wait for price to enter the overbought territory. So once the price falls below, okay, not staying above the level, once it goes below, not staying at the level, that kind of thing, you got to go below the 80 line. This suggests that what? The downtrend may be ready, right? The downtrend may be now ready to continue. So this would create potential areas to go short, to sell. So now, by using the stochastic indicator to time the end of a pullback, you can enter trades in the direction of the overall trend while avoiding the risk of entering too early, okay? During this kind of correction. You know, sometimes you enter too early. So this allows you to time potentially the end of the pullback with the stochastic itself. All right, so this helps you to trade with momentum and then obviously maximize your chance, right? Or increase your probability of success. So here, take a look at this example. The market is in a downtrend. Why? So the overall long-term trend is down because what? If you see this line over here, price is below the 200 period moving average, right? On the other hand, I mean, if price is above the 200 moving average, you would consider the trend in the overall longer term to be up. I mean, obviously inside there's up and downs, that kind of thing, but we are talking about the longer term. Okay, so now before that, you learn that you shouldn't just aimlessly, mindlessly go and sell the market just because the market is in an overbought area, or go long just because it's in an oversold area. However, like a trend, you can call it a filter using the 200 moving average, right? This will give you an idea, bigger clarity in your trading strategy, because right now you know the overall trend, the bigger perspective trend of this vehicle that you're trading right now. So for example, in a downtrend, the stochastic will what? Help you spot when the pullback might be ending, okay? By watching the overbought levels. So that's where you can identify potential reversal point to enter a short trade in line with the overall trend itself. So if the market is in the downtrend, you will look for what? The overbought areas, right? On the stochastic to find selling opportunities. And then on the other hand, in an uptrend, when the market is going up, you look for what? The oversold area to signal what? Buying opportunities. So now back to this example, which is in a downtrend. The overbought area signals what? Where the pullback is going to end, right? When the market is going down, the overbought area, right, shows the area where the pullback may end. So that's where you can enter the short position at these areas, right? So therefore, when you combine the trend filter, which is the 200 moving average, with the momentum indicator, which is now the stochastic, you can now avoid jumping, number one, in the wrong direction, and also jumping in too early pullbacks, because pullbacks may not just like going too early in a pullback is not a wise choice. So you avoid jumping too early, but yet staying aligned with the long-term trend itself. So this approach it aligns you to identify where the pullback in this downtrend might potentially end. However, I'm not suggesting that you should just, okay, I'm going to go short right now, I'm going to sell the market right now just because the market is in an overbought area. What I'm emphasizing is that the overbought area in the downtrend can indicate where the pullback might finish and where the downtrend might resume. So if you are going to trade this setup effectively, you don't act just based on the overbought signal in the downtrend. Instead, you look for an entry trigger. For example, such as a bearish reversal candlestick pattern, or another confirming signal that further indicates that the pullback is ending and the downtrend is ready to continue. So the stochastic indicator, it simply alerts you to the potential endpoint of a pullback. But the actual trade setup should only be entered once you have the confirmation of a reliable entry signal. Now let's look at this example, okay? Now what trend it is? Uptrend. So in this scenario, you should focus on what area? Overbought or oversold? Oversold, because it's in the uptrend, right? So you should focus on the oversold areas on the stochastic, where the readings, where the market is below the what? The 20 level, right? So this oversold area are often aligned with the swing lows of the market itself. And that's where it could help to signal where the pullback might end in an uptrend. So this will provide you opportunities to enter the trade at these areas to ride the continuation of the trend itself. Now, another valuable way to use the stochastic indicator is as a filter. Okay, filter, right? I mentioned the word filter before. It acts as a guideline to help determine whether you should go long or short based on the overall trend and momentum in the market, right? So here, in an uptrend, the stochastic filter now direct your focus towards the what? If the market is the uptrend, towards the oversold areas to help you identify potential buying opportunities during this pullback. So on the other hand, in a downtrend, the filter will guide you to look at the overbought areas to pinpoint areas to sell, shorting opportunities. So use stochastic as a filter will keep you trading in line with the trend than against it. Alright, so that it ensures that you align your trades with the overall market momentum, right, wherever it is. So now, how can you use the stochastic indicator to further filter your trading setup? Take a look at this chart, for example. You will notice that the stochastic indicator shows what? The oversold area during an uptrend. So what this means? This means this pullback could be nearing its end, and then the uptrend may soon resume. Okay, so now if you are trading on a lower time frame, for example the 1 hour chart, and then you saw this setup in the daily time frame, right? This becomes what? A very powerful signal. So right now I'm going to show you how to combine time frames. Okay, so the oversold stochastic on the higher time frame, it suggests what? It suggests that the overall market is still bullish and the pullback is likely just a temporary retracement within the larger trend. Here's where I'm combining two theories. Okay, on the 1 hour, you can use the daily signal to time your entry. On the 1 hour, you look for entry triggers, right? Such as what? Bullish reversal candlestick or other indicators to confirm that the pullback is ending. Alright, so now this approach will allow you to combine the broader trend context from the higher time frame with a more specific entry opportunities in the lower time frame. Alright, so therefore this enhances your strategy, right, and increase the potential of a successful trade, right? So now, by trading in alignment with the higher time frame trend, you increase your chance of riding the uptrend while minimizing the risk of entering against the market overall dominant direction, right? So now this area, right, this area on the chart serves as what? Like a warning to not to be too short or aggressive, right? As the stochastic on the higher time frame signals what? Oversold conditions. So this suggests that the market may be nearing the end of a pullback, increasing the likelihood that the uptrend will resume. In this case, you might want to avoid taking a short trade, a selling trade entirely. Or if you take a short trade, you got to be prepared to take your profit quickly, right? Don't set your take profit level too far away, because this could be just a minor retracement. All right, so therefore You got to set your take profit and your RR at reasonable level, right? To prevent the risk of it resuming back, okay? And this scenario shows that how you can use the stochastic indicator as a filter for your trading setup, right? This helps you to avoid trades that goes against the higher time frame momentum. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.